How to win big and lose small. Chapter 2, Trading Strategies. Trading strategies include entry point, buy size, stop loss, profit take, exit point, average up, and average down. Of course, there is no one in the world who gets 100% of their trades correct, not even remotely close, because if they can, they should be richer than Jeff Bezos or Elon Musk. Risk come with every trade, and what we can do is to increase the winning possibility. An extremely important point to note: your winnings must always be more than your loss. Now, this is the percentage of traders losing money. This is a survey done over few hundred brokers in the whole world. Now, we can safely say more than 75% of traders and retailers lose money, which is why I created my videos to share with you how to be on the winning side for free. Just subscribe to me and join me at the winning side. Any point can be an entry point. I shared before on technical analysis and will continue to roll out more technical and fundamental analysis videos so you can make a better choice and decision on where to place your entry points. But what if you entered at the absolute peak and it starts going downtrend? Most of the time, people hang on to losers and sell winners, right? It's because they do not have a firm trading plan and strategy. If you are very sure a company is worth 1 trillion in valuation and the intrinsic value is much higher than the current stock price, would you sell and buy back at a lower price? Or will you harbor the thoughts, what if it doesn't go any lower? And so you hang on to losers. So it's paramount that you do a due diligence before you enter to already decide on your stop loss, profit taking point, or if you prefer to average your costs. If you deem yourself to be a long-term value investor, will you average down? At what price? For averaging, it is important that you have some technical analysis knowledge to not average down at the wrong place, wrong price. To average, you need to know where the supports and resistance are. Moving averages, Fibonacci retracement points, these three are the most fundamental you need to know and you need to do to decide where and when to average. I typically use Fibonacci retracement as one of my bases for averaging down, but I will try my very best not to average down, as it will mean that I'm hanging on to losers that has probably plunged by at least 25%. Now, for Fibo, I typically use it on upswing, and I will treat this as my peak point for retracement. I will usually set my alert on 23.6% as my first consideration. For averaging down will be at 38.2%, followed by 61.8%. A lot of times you'll see price action bouncing between 23.6 and 38.2%, and then 50% and 61.8%. Which also means consolidation is occurring, and I will need to study what is happening to the company before I make my decision. Support and resistance of price using trend lines. We can use horizontal lines or diagonal lines according to the trend. Support and resistance lines are stronger if the same point has been met with multiple times. Example here, and you can see the price bounces off the line. It also serves as points for averaging, profit take points, and if it breaks the resistance, you can of course choose to stop loss. Bear in mind, you can have multiple stop loss or profit take points to reduce your exposure to a particular volatile stock. Moving averages serve as a powerful tool for entry point decisions. There are 3 components in MACD. Number 1, histogram. Number 2, the MACD line, and number 3, the signal line. MACD will have 2 lines, and the easiest way to differentiate it will be that the signal line is usually smooth, and the MACD line is like a short cycle or exponential moving average with a lot of jagged edges. Now, the easiest way to trade using MACD, you just need to fulfill 3 points. Number 1, the histogram is preferred to be below 0. Number 2, the MACD line crosses the signal line. And if you're buying, the SMA should be on the uptrend. Now, I briefly covered all 3 types of technical skills. Let me go into the important part of the video, which is sizing. Sizing is important as it will affect your behavior, your emotions, and your risk. Imagine you bought 100% into Lehman Brothers. Can you imagine that? So clearly you want to avoid catastrophic loss at all costs, which means that you need to size correctly. Let's split into 2 types of sizing, alright? First, all, and I mean all of your money putting into investments. So if you bought Bitcoin at $1, I'm sure you are a billionaire now. And if you bought Lehman Brothers, I'm pretty sure you're dead already. Or number 2, you decide to invest your first 5,000. You know, your savings could be $1 million or $2 million. I don't care. This is 100% of your investment capital. Then you need to think how you should size. Forget about what 1%, 5% theory theory of a portfolio of whatever you have. Now with $5,000, 1% is only $50, 5% is $250. Commission already made you unprofitable. It's so freaking stupid. You need to factor in up to 20% drop, and it happens very frequently in the stock market. Supposedly your tolerance is $1,000 before you lose or you succumb to the pressure and lose your cool. You can size your position to be $5,000. It's all about your ability to take the pressure. If you have done your analysis well enough, together with meaningful and correct sizing, you are taking the correct steps to profitable trading. Do not underestimate the emotional impact losses and gains have on you. After sizing, let us cover risk to reward ratio. Very simple for risk to reward ratio. Supposedly you are taking a look at this stock, which is Tesla, and you notice that the MACD cross is here and this is going inside the squeeze. So you are either thinking to buy in at this point or just waiting for it to have some changes before you make your entry. So you realize over here it starts to go up into a bulge, and then you can start doing some drawings. So for risk to reward ratio, we usually have 2:1. So let us do a Fibonacci here, and at this point to be at 100%, which is at the start of the bulge. And this is the Fibonacci extension to the right side. We'll realize the next few days it's all within this extension point. I'll do a Fibonacci retracement at 630 area and do a stop loss of 20% from 630, which is $503. It didn't hit my stop loss and went on to hit the 900 plus region before a whole bar is out of the Bollinger Band. This signals an alert. So I will redo a Fibonacci retracement and I will do a 20% stop loss, which will be about 710 region, and my profit take will be at the 1200 region. Supposedly we did the stop loss at $720. Fast forward 6 months, it has at last recovered to my stop loss area. Now this is just based on profit to loss ratio strategy. So that's it. If you like what you see, do subscribe for more to come.